Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Sharamati Izman. Today I will present about derivative securities in the Islamic market. Okay, first, what is derivative? Derivatives is a financial instrument that derives its value of its underlying asset. They have three types, which is options, swaps, and futures. Option is a derivative can be defined as a financial instrument whose value depends on or derives from the values of other more basic and underlying variables. Swaps. Very often the variables underlying derivatives are the price of trade assets. Three is futures. However, derivative can be depend on almost any variable. Derivative market. Derivative market have two, which is exchange trade and over the counter. Exchange trade (ETD) contracts that are traded on derivative exchange. Contract are standardized as defined by the exchange. Derivatives exchange acts as a counterparty to all contracts. Over the counter (OTC) contracts that are privately negotiated and traded directly between two parties. OTC market is the largest market for derivatives. Okay, main players derivative market. Hedgers. Okay, hedgers use derivative market to manage or reduce risk. They are typically business that use derivatives to offset exposure resulting from their activities. Arbitrages. Arbitrages ni should be price be divergent enough to make profit. Speculators it takes position in asset or market without talking of setting position. Example, if they expect a certain asset to fall in value, they would short the asset. Okay, use of derivative instrument. Use of derivative instrument. First is risk management. That is hedging, like example like farmer with corn flour. After that is speculation, essentially making bets on the price of something. Then reduce transaction costs, sometimes cheaper than manipulating cash portfolio. Lastly is regulatory arbitrage, that is tax loopholes. Okay, evolution of derivative markets. If one examines the evolution of derivative markets and instrument, the progression has been as follows. Like the image that like this. Forward contract to futures contracts, then options, financial engineering, lastly is exotic options, synthetic instrument, and swaps. Derivatives and risk management. Risk is a finance viewpoint, refers to the uncertainties associated with returns from an investment. These uncertainties will translate into volatility or fluctuation of returns from an investment that have two off balance sheets and on balance sheet. Off balance sheet. All risk management techniques involving derivatives are off balance sheet. The hedging mechanism or method is detached from the underlying transaction The advantage for off balance sheets is no need to change the way one does business, no loss of competitiveness, customer convenience, and other. Lastly, despite the popularity of derivatives based on balance sheet techniques, Islamic jurists have generally not been in favor. On balance sheet, the technique is one where a transaction structure is such a way as to manage the investment, the interest risk. On balance sheet techniques is quite only in ringgit. HIC increase the FC price equivalent to cover risk, pricing strategy, and CRCA, which is currency risk sharing agreement. Like example is Malaysian exporter and foreign customer. Okay, next is Islamic Financial Service Act 2013 define Islamic derivative as an agreement including an option, a swap, futures, or forward contract. This is made in accordance with Sharia. Okay, the type of Islamic derivative that currently in use are Islamic FX forwards, which called IFF, Islamic swaps, Islamic FX swaps, Islamic cross-country swaps, and Islamic profit rate swaps, Islamic options, futures, or contracts. There are numbers of muamalah contracts that have features resemblance derivatives and can be used for hedging, such as salam, istisna, urbun, and hamish jidiyah. The muamalah contract that are used to create products which have features similar to forwards, futures, options, and swaps are community murabaha, musawama, bai, al-inna, tawaru, and wa'ad. That is according to Sharia. For a sale to be valid, like the commodity on underlying asset must currently exist in its physical sellable. The seller should have legal ownership of the assets in its final form. Forward and futures in Islamic finance. Forwards contract. A contract between two parties for one party to buy something from the other at a later date at a price agreed upon today. It can be contrasted with a spot contract, which is an agreement to buy or sell an asset today. A forward contract is trade in the over-the-counter market. It is usually between two financial institutions or between a financial institutions and one of its client. Function in financial operation, hedge risk as a means of speculation or to allow a party to take advantage of quality of the underlying instrument, which is time sensitive. In this contract, both parties, buyer and seller, eliminate the price risk by locking in the price at which they would carry out the transaction at a future date. Okay, next. The main issues of forward and future is deferment in price and asset to a future date. A number of instruments or contract exist in Islamic finance that could be considered a basis for forwards or futures contract within an Islamic framework. These are salam contract, istina contract, and juala contract. Okay, OIC fake academy rule that differ both the counter value in the trading of commodities. Forward contract is not permissible, but recommend that such commodity trading follow salam rules in order to be permissible. Specification clearly made quantity, type, and date delivery. Okay, forwards and futures in Islamic finance have three: closing out and margin trading, views on permissibility of futures contract, stock index futures, SIF contract. For closing out and margin trading in futures, buyer and seller are required to take or make physical or cash settlement delivery upon expiry of the time specified, unless they close their position. Close position is the resell the futures before its expiry. This normally happen when the parties feel that the contract has been or fallen in their favor. Example, trader bought future contract. He will sell it to close out when the price is gonna up. Okay. On the other hand, if a trader has sold a futures contract, he will buy back to close out when the price goes down. The traders of futures don't need a lot money to start. Okay. Views on permissibility of futures contract. Okay, they have Imam Al-Haramaini, Al-Juwani that have said that future trading is permissible if the practice is based on darurat and the needs of the ummah. Sharia Advisory Council SAC of Security Commission. Futures trading of commodities is improved as long as underlying asset is halal. Crude palm oil futures contract are approved for trading. Stock index futures SIP contract. SIP is permissible as AC that an index futures should free from element gambling, jahala and gharar. Options. The option is financial instrument that convey a right but not an obligation to engage in a future transaction on some underlying securities in the future contracts. That have two types of option that call option and put option. Okay, call options give the holder the right to buy the underlying asset by a certain date for a certain price. Put option gives the holder the right to sell the underlying asset by a certain date for a certain price. Okay, the price in the contract is known as the exercise price or strike price. The date in the contract is known as expiration date or maturity. Okay, when viewed solely as a promise to buy or sell an asset at a predetermined price within a stipulated period, Sharia scholars find nothing objectionable with options. It is in the trading of this promise and the changing of premiums that objections are raised. Examine under the fiqh doctrine of al-khiyarat, contractual stipulation, or under the bai' al-urbun concept. Ahmad Muhyiddin Hassan, 1968, to reserve option trading contract is prohibited. Maturity beyond the 3 days as in al-khiyarat is not acceptable. The buyer gets more benefit than the seller. Swap. Okay, swap is a bilateral contract where the parties agree to exchange a series of cash flows at fixed periodic intervals based on the underlying asset. Second, purchase of swap exclusively over the counter. Other types of derivative include swaptions and hybrids. Their creation is a process called financial engineering. Third is underlying asset called the underlying. A derivative derives its value from the underlying. Okay. 5 generic types of swaps, that is interest swaps, currency swaps, credit swaps, commodity swaps, and equity swaps. Okay, the conclusion is the overall stance of fuqaha of conventional derivative instruments appears to be one of apprehensions, even suspicion, that these instruments could easily be used for speculation appears to be the key reason for objection. The derivatives form the basis of risk management appears to have been lost. Okay, thanks, that's all from me. Thank you. Hope you enjoy my presentation.